Morning, hello, and welcome to this presentation on volume balances. So today we're going to talk about what volume balances are, how they apply to fair valuation, how to anticipate them, when to understand their validity, and essentially understanding insights into what volume balances are and the engineering behind what volume balances are in price. So what I'm going to start with is I will start with a plain chart. I'm going to use that for our conceptual purpose on today's lesson. So we have to start first by defining the concept of what a volume balance is, and then we can go into price action itself and see in real time how they are utilized. Hopefully you enjoyed today's lesson and you get value from today's lesson, and I will try as much as possible to straight to the point and not spend a lot of time on hopefully series. Alright, so this is volume balance, and this is a lesson on volume balance. Now, going back into the previous lesson where we talked about fair valuation, and we did essentially an introduction to what fair valuations are. A fair valuation simply is an error of fair value to either bank traders. It usually is a form of an inefficient price delivery by the algo. Now, unlike fair value gaps, so when I talk about fair value gaps, I'm talking about SIBs and BISs. If you don't know what SIBs are sell-side unbalanced buy-side inefficiencies. BISs are buy-side unbalanced sell-side inefficiencies. So let's do this. So we have a SIBI being a sell-side unbalanced buy-side efficiency, and a BISI being a buy-side unbalanced sell-side efficiency. So we're gonna rehash the concept and we're gonna draw that out conceptually. So essentially, in a bullish delivery of price, the market will want to deliver the market price to a level of counterparty liquidity for distribution. Okay. Now, in the process of that run up into that counterparty liquidity, so let us define our counterparty liquidity level. So let's assume up here that's where we have counterparty liquidity, and that will be in form of an old high. So we call that a 1 hour high or a lower time frame high, like a 15 minute high. It could also be a daily high. Okay, it's still the same thing. We're just looking at an area or just going to be available buyers in the marketplace, which is what we'll call buy-side liquidity. Now, in the process of the algo delivering the market up into that, after institutional accumulation is into the market at the level of discount. Okay, so this is all discount, and the market starts to expand. You have the opening price. Just now, if you go back to the concept of that daily candle where I talked about open and then accumulation is going to be done below the opening price, the market starts to expand, which is a profit release phase, which is all algorithmically driven. Alright, all the accumulation is going to be done below the opening price of the candle, where you get the low of that candle. Then up here is where you have distribution from here, and then we have the close for the day. That was what I defined on the daily candle. Now, if you take this into each candle which prints on the chart prior to the market reaching up into counterparty liquidity, you have your opening price, you have delivery of sell side to allow for institutional accumulation, you have a profit release phase, which is all inefficient, and then you have your distribution up here. Now the next candle opens from the previous candle's close, trades a little bit lower, and starts to expand and reaches a high and does the same thing. And now we have the low of the candle here, and we have that of this candle here. And then the next candle opens up. It's not really trading to the body of the candle, it just opens up and starts to trade higher and starts straight back down below and closes like this. Then you have the high of this candle. So what I'm describing is how candlesticks form. This is how a bullish candle would form. Now, from our previous lesson on fair valuation, this is our fair value gap. The fair value gap is going to start from the high of this candle. The high of the first candle is going to start the fair value gap, and the open of this candle is going to end the fair value gap. Why? Because that was an error of one-sided delivery. Now this candle, if it had traded down and created a wick into this inefficient delivery price, then our fair value gap will be from the high of this candle to the wick of this candle. Okay, now remember, the preferred release phase, that is the artificially driven portion in price. The wicks are where accumulation and distribution, using that data range concept, will be done. Okay, if we have a wick down into the body of this candle, okay, then our inefficient delivery is going to start from the eye of this candle all the way up to the wick, because this portion price was delivered only on the buy side inefficiently. Okay, so think about this like we have an actual market gap there, right? But it's on the buy side. So we have buy side delivery only, just a lack of sell side between this range and price. That is an error of fair valuation, because that was an error of only one-sided delivery, and this is where you get your classic fair value gaps. Now with volume imbalances, volume imbalance, remember, let's go back to the actual name, volume imbalance. Okay, a volume imbalance involves the lack of volume in a price delivery. So going back to the same example here, what you get in this instance is you get the absence of volume in a section of price, and this is your volume balance. Now, unlike the fair value gap, where you would take the high of this candle and the low of this candle and consider that the inefficient price delivery, in volume balances you are using the close of the previous candle and then the open of the next candle as your volume balance. Why? Let's go back to the example or the lesson I did on order blocks and rejection block concerning volume. Remember, the bulk of the volume of transactions is going to be done inside the candlestick bodies. Okay, because usually the high and low of a candle can vary on the interbank level, but the body of the candles usually will stay relatively the same on an interbank level, so that it usually is indicative of volume in price. So when we have the market open up, trades higher, and then gaps an area of price and opens up into the next one, and then it trades lower from there, you have a lack of volume in an area of price, and that creates a volume balance. Okay, so that's our volume balance, and here the volume balance is one of the most inefficient price delivery mechanisms. Now, unlike sell side imbalance by some inefficiencies and buy side imbalance sell side inefficiencies, which have a one-sided delivery, so they have at least one side of price delivery. The volume balance has a lack of either sell side or buy side. Okay, there's a lack of any kind of delivery in that portion of price. So volume balances are one of the most inefficient forms of fair valuation in price on the interbank level, and they are very sensitive. They're one of the more sensitive PDAs in price, especially when you're coupled with another PDA like an auto block or a mitigation block, and there is a drawn liquidity. Now, typically, when I identify drawn liquidity and the spot of volume balance, that is a very strong confirmation of order flow for me. The reason being because the algo is wanting to quickly want to get up into that level of counterparty liquidity. So when I see volume balances in a run up into a liquidity like a short term high, usually I'm buying the retracement back down into that volume balance, anticipating a run higher into the liquidity. Okay, so this is what the volume balance is. This is for the buy side, and then for the sell side, you just invert that and you do the same thing. So let's assume this candle closed bearishly, and then the next candle gapped down and made the wick like this, and also the low of the candles like this. Then this is your bearish volume balance, or you can call it bearish VI. That's the short for volume balance. So what we're going to do is we're going to go into a live price action example, and we're going to look for volume balance in pairs. I'm going to use a chart of USD JPY. And if you're wondering what all of this scribbling is, this is from the lesson I did yesterday. So I did a lesson on volume balance, but that was at the Airbnb yesterday, and there was a storm going on, and the internet was also shitty. So I ended up spending a lot of time, and the audio turned out to be really poor because the storm was just overwhelmed, and the mic was picking up the noise from the storm. So I had to redo another one entirely. So that's why I have this. All right. So as with our example we've used on a previous lesson on volume balance, you can see here the market makes a turn point after running a short-term low. We have a shift in market structure after a break above a short-term high. We have a general liquidity up here. Now remember, whenever you see a volume imbalance in a run up into liquidity, that usually is a very strong confirmation of market wanting to quickly deliver into level of liquidity. So you have the market open up. So let me get rid of all of this. Candle closes like this. Next candle opens up, trades lower into the portion of that market gap. The next candle trades lower. So in this example, our volume balance starts from the close of this candle to the open of this candle up here. Now, unlike CBs or BISs, okay, there is a lack of both sell side and buy side. Now, when the market creates the volume balance, the next candle trades bearishly down and through the volume balance. Where's the market reaching for? It is reaching for a discount rate, which is a bull shutter block. Now I know you can spot already the BPR here, because there's a small little BPR there. And if you're asking a question, why would I not wanna? If you were looking at, because I'm sure a lot of you guys will have this question in your mind. In this example, would you want to buy at the BPR, or would you want to buy at the order block? And the answer is going to be the order block. Okay, a balanced price is an air balance. Okay, a lot of times the market does not even need to trade down there, because that already is an efficiently delivered price. Okay, so whenever I have a discount PA rate above a BPR, that's what takes precedence first. But now, when I'm using a stop on the idea, the stop has to go below the balance price range, because it could still potentially get utilized. So I have to take that into consideration. All right, so we have a bullshit block here. The market trades down into that bullshit block. We have a range of our volume imbalance. Okay, so this candle trades down in third, then the next candle trades down into the other block, and then once we pick up institutional orders, algo starts to deliver the market higher. So this is our redelivery. Okay, candle trades down here, deliver sell side of the volume balance. Now, volume balance is just like every other type of inefficiency. Okay, we have the primi, which is the high of the volume balance. We have the consequent encroachment, which is the 50% of the volume balance. So these are all sensitive levels inside an inefficiency. So it could be a fair value gap, or a balance price range, or a volume balance, like this example. So these are sensitive price points. We have the discount low here. So right here we have redelivery of the volume balance. Okay, so we trade it down there on the sell side, and trade third on the buy side, and then this candle opens up and rebalances this. Okay, and trades down into a propulsion block, because this is a bullshit block. This is a propulsion block. Candle trades down there into the body of that propulsion block, and it does what propulsion block does and expands higher. Now, if you look closely, you can see in alignment with that propulsion block, we're utilizing the consequent encroachment of that volume balance for order flow. Okay, so all of this here was just simply rebalancing of this volume balance, and then market starts to deliver higher. All right, let's go to the left and let's look at more price action examples. So you can see that this candle trades down into a bullshit block. But in the process of us trading down to a bullshit block, we'll clear out sell stops. So in a bullish order flow, any run on a short-term low, that is not a breaking market structure. Instead, that is a terrace long, or a false breaking structure, to sell the idea that the market has made a top and it wants to run lower. So that forces people to want to short that break of that short-term low, and then institutional traders can go and be counterparty buyers against the shorts, or which I call retail shorts, and algo continues delivery higher. Now, inside this down candle where we do some accumulation in price, you can see we leave the range of that down candle with a volume balance. So again, algorithmically, we're going to be drawn to the volume balance because that is an area of fair valuation price, and you can see the market trades on there. As soon as the market trades on there, which is what we'll call redelivery, interbank traders are going into the marketplace and they're piling on longs, or they're accumulating longs, because they understand that the market is poised to expand higher due to order flow. Okay, and then you have this expansion higher. Now, when we get up into a high, a short-term high, or I think a long-term high on USJPY, we have a down candle, and then the market trades up into a bearish order block here. Price trades up into a bearish order block. So we start to sell off, and then the retracement back up into this propulsion. We have a volume balance there. Now in this example, because the delivery is now bearish, not bullish, what you're looking for is once the market trade through the volume balance. If we can trade through the volume balance, then it has to act as resistance in price. All right, so it becomes an inversion level. So this is the volume balance here. In this example, you're not expecting higher prices because you have a shift the market structure. What is the shift in market structure? Look at this fair value gap. We completely traded through the fair value gap here. Okay, completely traded through the fair value gap here, and then we had a short-term low, which is this, which we've broken lower. So we've made a lower low in market structure. And we have this liquidity as the general liquidity because this is the low prior to this run higher. So this is our parent price swing. So what we're looking for is when to see the market expand down into the sell side liquidity of our parent price swing. So the general liquidity is down here. Now with this example, because we're now bearish, we're not looking for this to offer buys. You can see how many times it gives a false indication that it wants to go long. If you're looking at this and you're not aware, you would want to go long on this. And this brings me to this discussion here. In all the concepts and all your understanding of all the different concepts I'll share throughout the course, they're all dependent on the general liquidity, or they're all dependent on order flow. If you cannot put into context where next general liquidity is or where order flow is, then your concepts are useless, or pretty much useless. Okay, now let me explain so hopefully it makes sense. The concepts being taught, they're simply market narratives in the delivery to liquidity. Okay, they're simply a way of creating a storyline in how price should be delivered into a level of liquidity. What starts the story entirely is the general liquidity. So if you miss that general liquidity and you get it wrong, then your storyline has no meaning. It is meaningless, okay? Because it has no context to back itself upon. So the first and the most important aspect of your analysis has to be the general liquidity. Because if you get the general liquidity wrong, then you will misinterpret behaviors like this. So in this example, if you're thinking the market should go higher, you're looking at this as a buy signal because you have a bullish order block and a volume balance, and your mind is that's a buy. But if you knew the general liquidity is this low here, then you know you're expecting the market to trade through, and then you have your shift in order flow. And this is what we call a rebalancing. Okay, this is all redelivery. Then as soon as the market trades through, this is rebalancing. Alright, so inside this range, we only have the market trade through on the sell side. Remember, this is a level of volume imbalance. Okay, there is no volume there. All the weeks, these are not volume. This week is not volume. This is not volume. This is not volume. But as soon as we trade through that in a rebalancing, or sorry, redelivery, then we have a bearish fair value gap here. It's still a volume balance, but with this, it becomes a bearish fair value gap there, this range in price. Okay, because we now have inside this portion of price, we now have sell side delivery, but there's no buy side. So guess what happens next? Market has to trade up there, buy side, allow for accumulation shorts, and then the distribution starts, and we start trading lower. And here you can see how we trade through that volume balance on one pass. So if we visit that level in the future, it should offer some type of sensitivity for a distribution of any longs, including down here, a discount. If we for any reason come back up into this in the future, it will offer some type of sensitivity there. And that is for this. Let's see if we can find more examples on volume balances to wrap up the video. Again, it's just not really a lot of subject matter here. It just is straightforward in terms of price delivery. Like I mentioned before, volume balances are one of the most inefficient algorithmically delivered or one of the most inefficient types of delivery in order flow, that is volume balance. Now they are separate from new day opening gap or new week opening gap, okay, or new month opening gap. A volume balance is different from the opening gap of a trading day or a trading week or a trading month. They're not the same thing. I'll do a lesson on opening gaps, but they are different from volume balances. Okay, with opening gaps, you're using the entire range from the last close to the opening price, where just no candlestick body. You're taking that entire range. But for volume balances, we're more interested in the candlestick bodies. Okay, I think we can see one here. We can also see one here, so I'm going to outline that. So this is the wild flash crash of 2020. So we have a bearish volume balance here, and you can see that is coupled with a bearish shoulder block. So inside the bearish shoulder block, we have a bearish volume balance there, again from the close of the candle to the open of this candle, where there's no actual candlestick bodies there. That is our volume balance, and you can see how the market trades up there and offers long-term sell off. Also at discount here, we also have a volume balance there. Okay, and you can see as soon as we trade third and above the volume balance, you can see how it acts as support there. Okay, this is what we'll call rebalancing. All of this is over delivery of that volume balance. And if I extended it out, you can still see the sensitivity there until we break through. You can see how the market trades down there, offers buy, trades back down there, offers buy. So you can see how the algo keeps drawing price to that level. Even though it wants to trade lower, but it is finding, or it is stalling in trading lower. Why do you think so? The reason why is because any of the accumulated shorts up here, or any of the distributed positions up here, okay, they're being distributed against a level of sell side liquidity. How's that sell side liquidity? Because it is a bullish volume balance. Okay, so the algo will still remember that area in price in the future where there was a lack of sell side, because after we created this volume balance, we balanced this on the buy side. Now obviously we came back here and traded down into that on the sell side before expanding higher, but still when this was created, this was an era of, after this candle formed, that was an era of a lack of sell side delivery. So that is a form of sell side liquidity. So the market comes down there at discount, it will remember that price and it will leverage that for distribution of shorts, because that is a discount rate there. And you can see how it acts as after we trade third, you can see how it acts as an inversion level. If I use my Fibonacci to identify the range there, you can see the constant encouragement of that volume balance, which used to run this sell side liquidity here. So after we trade up there, look at the bodies of the candle accumulating around the PMI of that volume balance, and then we traded lower. We trade up into constant encouragement, and again up into constant encouragement, and then up into discount low, and then finally run sell side liquidity on the daily time frame. And then after that's done, we trade down into a small little fair value gap here and completely shift higher in price. We'll continue to expand higher in price. So hopefully this lesson on volume balance was insightful. On the next lesson, we'll talk more on market gaps and redelivery balances. With that being said, you guys will have an awesome day and trade safe.